Welcome to another episode of the Southside Blueprint. I'm Aaron Krahling with the Southside Group Real Estate. I've got Billy Rabbitt here, also with the Southside Group, and then Mike Kosmides from Responsive Mortgage. Mike's going to talk to us today a little bit about investment products for real estate investors. So as far as mortgages and things like that are concerned. So Mike, tell us a little bit about how you got into this, how you got started as an investor, how you got into mortgages, and what you might offer to investors as far as products are concerned.
Sure. Thanks, Aaron.
Yeah.
I quit my job back in, I think, 2000 and didn't know what I was going to do. I'd been selling staffing for 4 years at Aerotech, and one thing that I did right was while I was still working, I had invested in 2 yet-to-be-built townhouses in Ashburn and put deposits down and kind of forgot about them. And then a year and a half later, when they were ready to be built, they'd appreciated a good amount.
Oh, yeah, I own a house.
And ended up selling them and realized I could make more doing that than I could by working 60 hours a week at a staffing company. And
Sure.
I got into flipping houses, and me and a childhood buddy started with our first property, which was purchased at a foreclosure auction in Reston. And
this was before the bubble pop?
this was 2001.
Okay. All right. So you're kind of on the the ramp up period.
So I can tell you I can go up to the bubble popping with you and tell you all about that.
We love stories about the bubble popping.
Oh, yeah. So we decided to try our hands at a foreclosure auction. We went to the county courthouse in Fairfax County, and we ended up winning the property with the highest bid, and the property was beautiful. It was a condo in Reston. From the outside, it was absolutely gorgeous. The neighborhood was great. The comps looked really good. We were on Easy Street. Now, you buy these sight unseen, so you don't know exactly what you're getting, but what could go wrong, right?
Mystery box.
I mean, it looked beautiful from the outside. And so
I'm sure the people didn't tear it up on the way out. No way.
Well, we didn't really know if they did or not because the windows had been boarded up.
Okay.
But still, it's okay. It was a beautiful place from the outside. If we have to replace a few windows, no problem.
Sure.
Well, that was the good part. We won the condo. We signed our contract, and the condo was then ours. It was our responsibility. We got we didn't get the keys. We had to have a locksmith come to unlock the door for us.
Break the door open.
And we had a little surprise waiting for us in there. Besides the fact that they'd torn out all of the furnishings, they'd poured concrete in the toilets and stuff like that.
Oh, nice.
There was a dead body in there.
But wait, there's more.
So we saw there was a legitimate dead body in this place, and this gentleman, I guess, had fallen on hard times, but he was a Yale graduate, very well written, because we found a journal and then this 500-page manuscript, and on the last page of it, we didn't go through the entire life story, but we did see the end. We're on the last page, and the last page was, and that's why today I've decided to take my own life.
Oh wow. Wow.
So
Welcome to real estate investing.
our very first
Oh
property,
my gosh.
and this wasn't even our worst one.
Oh Lord.
So we have to, call the county, obviously, get all that stuff dealt with, and then we've got a home to deal with that was in total disrepair.
Sure.
My buddy and I had, quit our jobs to do this, and we'd used up all of our money to buy the property. So we had to do the work ourselves. We had to rent the U-Haul to haul the junk out. We had to paint, repair stuff, and it was a mess. And we ended up selling the place and doing okay with it. But it was our first jump into the big pond.
And you kept going? That's amazing.
And we figured it couldn't get any worse than that, right? We got the hard one out of the way. So the second one was in perfect shape. Brand new carpet.
No dead bodies.
No dead bodies.
Nice.
It was actually it was vacant. Brand new carpet, brand new paint. Kitchen remodeled, beautiful. It was in a neighborhood in Alexandria. It was a condo that was completely, it looked like it was completely brand new, and we didn't understand. We bought this one also from a foreclosure auction, and you buy them sight unseen. We were expecting the worst. Turns out we got the best. We wouldn't, we had maybe $15,000 factored in for our renovation costs, and our renovation costs were going to be zero because we didn't have to spend any money to fix it.
Sure.
So I, had my real estate license, and with a real estate license, when you're doing these things, you get to save on the commission piece of it.
Yeah.
And you also get to meet the buyers, understand the market a little bit better, have just a better understanding of how to price, all that stuff. I think it's definitely a good thing to
yeah.
But if you don't know what you're doing, having a really, really smart, investment savvy realtor is worth its weight in gold, worth so much more than you could ever save in terms of, I'm going to save myself 2.5% or 5%, whatever else.
Sure.
Is such a fool's errand, because you end up paying for it times 10 in the long run if you don't know what you're doing. That's why, with the service that you guys offer, from my experience with your team, a lot of your top agents are also investors.
Sure, yeah.
And they understand value. They understand that they've done, they've seen dead bodies too. They've seen all that stuff. And it's so important to have that experience on your side, and you're going to do so much better on your investment. And don't be thinking about the pennies I might save on this one. Think about, how am I going to get to 10? Sure. How am I going to get to 10 of these where I'm managing a portfolio and everything's about rental income? And the only way you're going to do that and to truly grow an investment portfolio is to have a really good team quarterbacked by a very seasoned, very investment savvy realtor.
Sure. So you got into I guess, investment properties and real estate, I guess you said early 2000s, right before 2008, you started ramping it up. So you had your license at the time. You were buying them, you were acquiring them, you were fixing them, and you were selling them. So you were the kind of the trifecta there. So I guess talk us through. So you went through the first two, you got through those.
Well, let me just finish the one thing about the second one. So it was immaculate and spotless. And so I had a real estate license. I put a lockbox on it the next day, and I put it on the market.
Okay.
That's how I thought God was looking out for us.
Sure.
He, dealt us a blow on that first one, and now it's going to be easy. So, now, as opposed to rethinking our lives, we're like, this is going to be great now.
It was testing how committed you really were.
I mean, I don't think, has anyone done a flip where they can put the lockbox on the property the day after they
No.
sight unseen?
No, exactly.
But
That's crazy.
Did.
Yeah.
I put the lockbox on the property, and life was good. We were going to, get a nice spread on this one. No renovation costs. And so I got my first showing request.
Okay.
A realtor called me and said, Mike, we want to show the property, but it says that it's vacant. Yes, it's vacant. Yeah, you can go and show anytime. She's like, no, we're here, and there's someone living in the property.
Sight unseen.
I'm like, you've got to be kidding me. They're like, no, someone's full on living here. So we go over there, and the property is immaculate and fully renovated because
Wrong property.
the grandfather of the woman who is squatting in the condo ratted out the local drug gang.
Oh.
And so in retaliation, they threw a Molotov cocktail through his window and burnt the entire building down. And so the insurance company rebuilt the entire building, and hence a brand new condo that's nicely painted and renovated. But
so you're selling their house.
The neighbors weren't too happy that she was back in the neighborhood because apparently she had a falling out. She left a baby on the steps.
Oh my gosh.
Of one of the neighbors, and so they started a riot in the streets.
Oh wow.
We had to have the police come and remove her. Her boyfriend was wanted for 2 homicides.
Any other house.
And mind you, we're still completely broke. We have no money to pay a crew to do any of this stuff. So the next day, my partner and I are out there. We're removing all of the furniture that she'd moved in, and we get the call from the police saying, "Oh, hopefully you guys are using gloves because she's HIV positive."
Oh wow.
So those are the first two.
Okay.
Those are my first two.
Wow. And you stuck through. I mean, how many houses in your career so far have you flipped, or how many investment properties have you been part of?
Like In the 80s, like close to 90.
Okay. Most of those in like the Northern Virginia area?
Most of the Northern Virginia
Okay.
area.
All right. So yeah, so I don't want to say you've seen it all, right? Because there's always in the next story, but you've been pretty well-rounded about what you've experienced, firsthand experience, whatever, through these flips. And I know you were mentioning about having a good team and things like that. So you're doing these investment properties. I guess you sold both of the two that you had mentioned, right? So those got those two behind you, thank God. And so you're moving in or whatever. So I mean, let's take us through like 2008. I mean, I know, I necessarily wasn't selling real estate back then, but you got through 2008 or whatever. I mean, what did that do? Did that help kind of catapult you in your investing career, or did that kind of put that on a hold?
So we were in the middle of a closing for a property that we bought in Manassas from the Prince William County Courthouse.
Okay.
We renovated it, and by this point, we'd done several flips, and this was 2007.
Okay.
And we were at a closing in Fairfax, and the buyers were 4 non-English speaking families using 105% financing on a 3-year balloon arm to buy the property.
That's crazy.
No income, no assets. There was no qualifications. They weren't even putting up $1 to buy this property. They were actually getting money back at the closing table. And these folks were going to buy a property with a $500 a month mortgage that was going to be a $2,000 a month mortgage in a couple of years.
Sure.
And that was the day my partner and I looked at each other and we said, we need to get out today.
Yeah.
And we sold everything. I got into the restaurant business for 17 years.
Okay. All right.
And then got back into real estate when we started a family. Because the restaurant business is not very family friendly.
Sure. Yeah.
But I can share the benefits of my experiences with you because, Billy, I've seen a lot. I haven't seen it all, but I've seen a lot.
Right, I bet just those 2 stories. I mean, like, wow, like that's crazy. I mean, that's enough to ruin somebody, and then for you to continue to kind of push through that is pretty crazy. So, Aaron, I know you've done some flipping and some different investment properties. Any crazy stories like that?
Nothing too crazy. Mine have all been pretty straightforward.
Sure.
I did have one in St. Louis. It was a quadplex, and long story short, my partner rented it out, so we were never able to fix the place up. So, but back to Mike, I did have a question. So you've been doing this for a while. Can you kind of walk us through? So these first few properties that you did, you might have had a different, funding strategy than you do now. Could you kind of walk us through, what you did back then, and then kind of how you manage things now?
So there was no DSCR when I started doing these. I did all of my flips with hard money. For the most part, maybe a rare few.
For our viewers, can DSCR and things like that? I mean, they probably don't realize what that is or whatnot. Can you tell them, I guess, what a DSCR loan is, and then also like what's hard money?
Sure, DSCR, debt service coverage ratio, where there's a product out now that every investor seems to have leaned into, and out of hard money. Hard money is you go to a private investor who is not bound by the state or federal lending laws.
Sure.
They're not licensed brokers. They're not licensed lenders. They can give you a private note. They charge you typically 3 points up front, so 3% of your loan amount you're going to pay in cash at your closing. And the typical interest rate is probably 11 or 12% for a hard money loan.
Okay.
That's why it's called hard money. and these are great in terms of, there's little to no documentation.
Sure.
You don't have to, on a conventional loan, Billy, you are providing tax returns, you're providing pay stubs, you're providing income verification, you're providing your firstborn, basically.
Yeah.
With investor-based loan products, the qualifications are much more simple. With hard money, there's literally no documentation. Yeah. Everything is based on the property.
Borrow from your uncle or something like that. Yeah.
With DSCR, the reason why DSCR has become so popular, and DSCR is truly, one thing about hard money is there's usually a 3-month grace period where you don't have to make any payments.
Sure.
After those 3 months, you're paying a 12% note every month. So if you don't know what you're doing and you can't turn that property around quickly and get it sold, and the property doesn't take, you've got to go in there 6 to 10 weeks of renovation time. Then you have to get it ready for market, get it staged, get it listed. Then there's the time on market. Then there's the closing time, which is usually 30 days after you get your contract. So typically 5 to 6 months you're carrying this property. Half of that time you're incurring carrying costs. Those costs add up at 12% a month.
Oh, sure, yeah.
And if you get stuck on a hard money deal and have to hold it for a longer period of time, it's really expensive, and it cuts big time into your margins and into your profitability. DSCR is also based on the property, not based on income verification. You're asked for 2 months of bank statements and your credit score.
Sure.
Essentially. Everything else is based around the property. We're going to take a look at the appraiser comes out. They not only do an appraisal of the property, but they also do a rental appraisal based on the rentals in the area. So the formula is, does this rent cover the monthly mortgage?
Okay. So it's what the property can do, not what it is, versus, what it is the hard money model, and what it can do is the DSCR model.
Exactly. And these properties aren't encumbered on your credit profile like a conventional loan would be, and you're able to grow and scale your business accordingly. They look at these as, okay, this is not considered a liability if the rent is covering the mortgage expense. So the other benefit to DSCR is the interest rates are close to conventional.
Wow.
Maybe, 50 basis points higher. Sometimes you pay some points if you want a lower rate, whatever else. But the rates are, for a no-doc loan, very good. The property is the collateral. The rent is the debt service coverage.
So I guess the lender in essence is really just making sure and ensuring that this is a good investment for the investor, right? So they're pretty much saying, hey, you're covering the costs, you got a little bit of equity, paid out or whatever, I guess, at the beginning there. And I guess you were saying that some are as low as now, it's like 85% loan to value?
We can now do an 85% loan to value on DSCR. So You're looking at 15% cash out of pocket.
So I guess for an investor now, so if you're able to find a property that will cash flow for you, it's a no-brainer almost really to get into this product or whatever, because it's really limited risks, limited documentation. And really, I guess in essence, the lender's really just building their portfolio of properties because these are all good investments for them.
Sure. You touched on two things, Billy, that I wanted.
Yeah.
You just brought up two really good points in terms of, yes, we make sure that the investment is good for the investor.
Sure,
right?
Sure.
Real estate there is no investment like real estate. You can buy $100, like $10,000 worth of Bitcoin, and there's no appraisal that has to happen.
Sure.
There's no one telling you that what you're paying for is worth what you're paying. In real estate, that is the case. They're not going to let you overpay.
Sure.
You have a contract with the seller that says, if I overpay, we can renegotiate our terms.
Right. Yeah, for sure.
You have a realtor holding your hand through a transaction that knows the market and can tell you, what's what. You're protected on so many different levels.
Sure.
And you're looking at, I think 5 of the last 75 years, real estate has gone down.
Right.
So you're buying an asset using leverage. So your return on your investment, because of the leverage, because of the certainty of the rise in the appraised value of the asset, is so much safer and better than anything else.
Yeah, no, for sure. I mean, I think on average, we did the math, I think about a couple weeks ago. And so I think out of the last 30 years or whatever, I mean, it's pretty much real estate, especially in Maryland, has appreciated, 4.5% or so, with only a handful of years being, depreciation. So yeah, it's definitely a smart investment or whatever. So it sounds like that. So, with all your experience, and now I guess now on the lending side, finding investors, offering them this new product that seems like is really a no-brainer for an investor that wants to hold the property and wants to build a portfolio, which I think is really most investors' dream, is to build a portfolio that's cash flowing. Like you said, Mike, it's very stable, really. As long as you're buying the right investor, you got a good team around you helping you make these good investments. So, if you were talking to somebody, because we get this question, I think, all the time. It seems almost like on a everyday process. Somebody comes in, they want to ask, they're looking for foreclosure properties, right?
All the time.
So that's always like
I don't know what they're asking.
Yeah, exactly. Pretty much they're saying to us, without saying, hey, I want to get into real estate investing, whether it's flipping or holding or whatever. What would you tell Mike? Somebody that's pretty much been on the investing side of over 80 real estate transactions here in the DMV area. What would you tell somebody that was looking at real estate, as an investment portfolio or as an investment strategy for them? What would you tell them? I guess let's say what's the top 3 things that they need to be aware of?
First off, with can you find me a foreclosure, whatever.
Yeah.
Fannie Mae and Freddie Mac, they're most likely not going to lend on a property that doesn't meet certain criteria.
Sure.
So if a place doesn't have, if the kitchen's ripped out, if the plumbing's not working, whatever else, they're not going
dead body.
They're not going to approve a loan. With DSCR, if the as long as the rent appraises for what it appraises for, you're good. So that right there, that loan product is beneficial to somebody.
Sure.
What is the most? Every investor we work with, they're all self-employed, right?
Sure. Yeah.
And what is the number one benefit of being self-employed?
Write everything off.
You get to write everything off. Well, the government makes it very hard for you to buy a piece of property without paying your taxes.
Sure.
They want everything in the lender model is based on what is your taxable income.
Sure.
We're going to approve you based on what your taxable income is. And they go to painstaking lengths to prove income. They look at tax returns, whatever else. With DSCR, investors don't have to show any income. There's no income documentation. It's solely based on the property. So I would say, if you want to get into this, start by, come up with a realistic goal. Sure. I want to have my first property by X date. Set aside an allowance every month to save up to the point where you can afford 20% down payment on a property that you can qualify through the rent value. 15%, 20%, whatever. But you need a little bit of you need a little bit of cash to get into it. But with DSCR, you don't need much else. You don't need to show 2 years of salaried income with a stable employer. You don't need to show all these taxes you've paid, whatever else. You don't need any of that stuff. You just need a modest down payment and a property that is in an area where you could consistently get market to above market rent.
Gotcha. What about experience requirements for qualification? If it's somebody's first deal, but it's a really good deal, they've got 20% down, could they still proceed, or do they need some sort of experience with HUDs?
Typically 12 months experience, 12 months rental experience is what. Now, there are different DSCR investors with different criteria. I'll say that. But what we've been seeing from the DSCR we do, and our company funds most of our DSCR in-house. Gold Star, our parent company, funds most of our DSCR products, and we've got a really good DSCR program. But Gold Star and a lot of the outside investors that we also pull pricing from, we don't just, we would love to bring everything in-house, but we're going to give you whoever gives us the best price.
Sure.
And some of these investors who give us a lower price typically require 12 months of rental experience.
Gotcha. So if they require 12 months of rental experience, it's like, I can't get the loan because I don't have 12 months of rental experience, but that's what I'm trying to get into. What would you suggest to somebody just getting into it to be able to get that experience?
If you want to get I got my foot in the door by buying a property with an FHA loan. I put 3.5% down on my first property. I was 24 years old. I bought a townhouse in Reston, not that condo with a dead body, but I bought a townhouse in Reston with 3.5% down. My mom was my realtor. My mom was with Long and Foster for 30 years. She was my realtor, and she got the seller to pay my closing costs. So I wasn't out of pocket for anything more than the 3.5% down payment. And within a year, I was able to rent it out and move on to when I moved out of the area, I was able to use my first-time home buyer status again because I was moving more than 50 miles away from my job. But I was able to rent out my first property, and that's how I got my rental experience. Back then, there was no DSCR, so I didn't need the rental experience.
Sure.
But if you want to get started investing, absolutely, the very first thing you should do is not. I take that back. Don't worry about saving up for 15%. Buy your first property. Use an FHA loan or a low down payment loan to get into the game. Pay it down. Get into it. Get out of the renting game. The renting game is a fool's errand. I can blow your mind with numbers of comparing 3 years of your life as a renter versus if you started that 3 years as a homeowner, and how much more of a net worth you would have. And how
sure. Yeah. No, for sure. Yeah. It's, so it's kind of funny. So when the market got, hot, in 2021 or so, when the market was just absolutely on fire, it was amazing. So as it started to cool down some, we saw so many, and I'm going to use air quotations here, investors, especially in Southern Maryland, right? Because I think you and I were talking about this earlier, Mike, was that, Southern Maryland is still, like, when you look at the DMV area, you look at Maryland, especially, within an hour of DC, Southern Maryland is still probably the most affordable area for people to come to buy, right? And so, it was amazing. We would see this house or whatever in a marketplace where, it was 30% over, any of the comps or whatever. And it was like they were justifying or trying to justify pricing based on other neighborhoods or other areas. And it was like, oh. So I feel like the acquisition of the property, whether you're flipping or you're renting or whatever, the acquisition cost of that property is so critical to you. And at least with the DSCR loan, there's some safeguards in place where they're not going to allow you to buy it for over market, where a hard money loan, typically you can. I mean, I know sometimes they'll do an appraisal or they'll at least make sure that their investment is okay because nobody wants to foreclose on anything. But it feels like that's such the important piece of this or whatever is the acquisition cost and really understanding what you're buying or whatever. Talk about, you said team earlier, and of course having a good realtor partner that understands investing, understands kind of what you're looking to do, understands the product types, right? What you can and can't do and some of the pitfalls around there. What other, I guess, team members, if you were building out an investment team today, Mike, what other investors do you think are critical in a successful investor?
Well, Southside has a title company in-house. I think that's really important. Someone that can work with you from the jump to get title work going prior to your closing. If you have a wholesaler that, I don't believe that there are such things anymore as wholesalers. I think everything is retail now.
Sure.
But one thing that I did want to mention about DSCR real quickly, Billy, is there's a renter. You were talking about the margin of safety and being protected when you choose to, if you want to overspend, they don't let you, basically. If the rent appraisal comes in low and you're worried about not getting your financing, one way to circumvent that is if you already have the property rented, as long as we have 2 months of rental history, we can use your current 2 months of rental history, including 2 canceled checks for payments. We can use that in lieu of the rental appraisal. We are working on multiple deals now where the rental appraisal, said one thing, but the lease history said another.
Sure.
And it didn't increase, the out of pocket for the buyer. It didn't change the terms of the deal. They were still able to keep the lower interest rate, still able to keep cash to close to a minimum.
Okay. All right. That's good information. So I guess shifting a little bit away from the DSCR loan, let's say, because we get this question all the time too, is So somebody's locked in, right? And we talk about the golden handcuffs all the time, right? So, they've got a 3% interest rate, and all of a sudden they're looking and they're like, oh, this little 1,200 square foot Rambler here without a basement is getting a little tight with my growing family. We want to look into other properties or whatever. Let's say their mortgage is, let's say, at $1,400, and let's say it rents all day long for $2,200, $2,400. There's definitely some money to be made there or whatever. Can they go? I mean, is that going to hurt them? Let's say they can find somebody to lease that property. Is that going to hurt with their debt to income ratio, like qualifying for a new house, or is there ways around that it won't hurt them?
Not at all. They get the best of both worlds. They can keep that 3% mortgage from COVID.
Sure.
They can hold on to that property while it, at the very least, keeps up with the rate of inflation every year.
Yeah.
And continues to appreciate while, the best mortgage payment is the one that someone else makes on your behalf.
Sure.
Right? So they can hold on to that property as it continues to appreciate in value, but also while someone else is paying that note down every month.
Sure.
You're double dipping on top of the fact that it's a leverage rate of return because you probably bought that property for 3%, 5%, 10% down, as opposed to, buying $10,000 worth of stock for $10,000.
Sure. Yeah.
The formula we use would offset that liability because they have a $2,200 a month renter in there. We can take 75% of the current market value of their lease and use that to offset the liability. So it would not affect them at all. In fact, if there's any overage after we take 75% of that, let's say there's still a few $100s a month left over, we can count that towards their income
Sure.
on the DTI.
Yeah.
So it absolutely does not hurt them, but they don't have to get rid of, a lot of people, I'll never get rid of this mortgage. You don't have to. If you're, cash flowing and getting a good renter in there who can offset that liability, we do not hold it against your debt to income ratio.
Yeah. And I don't know. I mean, certainly something I talk to people about all the time too. I mean, if you're going to be an investor, right? And let's face it, if you own a rental property, you're an investor, right? So that's an investment property. It's got to be a long-term play. You know what I mean? You can't go in there and just try to find a tenant for a year and then maybe you'll sell after that, or I'm not sure. It's got to be a long-term investor because, Mike, it takes one bad tenant to all of a sudden ruin a year worth of profit, on a property. I mean, just goes in there, tears up the place, destroys it. You've got to be looking at it from a long-term investment for sure. But I think that there is definitely a conversation to be had because, if there is enough spread, right, between your current mortgage and then what your new mortgage is going to be or what you're going to rent it out for, that might help offset some of that extra additional interest or whatever that you're paying in the higher interest rate on the new house. That might offset it or whatever completely. And I feel like sometimes it's like you really got to look at this from a total package standpoint of all your different options. And that's what we try to stress a lot of is to have a conversation and really understand all the pros, all the cons, all your options, whatever. And then ultimately you make the best option or you choose the best option for your family or what makes the most sense, whatever. So I guess, we'll shift gears, I guess, before we wrap it up or whatever is, I mean, the market right now is definitely crazy. I mean, there's definitely deals to be had. I mean, people are getting, the full closing help paid for. And then the next minute you're seeing houses, go over asking price. So there's no rhyme or reason to it. What are you seeing, I guess? I mean, is there some optimism in the marketplace when it comes to interest rates and what the market's going to do? What are you seeing, Mike?
Yeah, absolutely. The market is, we're never in, I hope we never see 3% rates again, because that means there's either a zombie apocalypse
Sure.
or nuclear fallout.
Right.
There's the only two ways we'll ever see 3% rates again. It's never going to happen again in our lifetimes. But rates relative to where they have been historically are low right now. And rates, as of yesterday, I think I sent you, we had another 6 basis point drop in the national average yesterday. Rates are the lowest they've been in 3 years. And we have a lot of optimism revolving around what the Fed's going to do today at today's meeting, and what they're going to do on the 14th and 15th of December. I think they're going to cut this week, and I think they're going to cut again in December. And the game has changed a little bit. That doesn't necessarily mean that mortgage rates are going to go down like proportionally.
Sure.
There's a little more spread built in now, but that's a longer conversation.
I think what it does though is it builds optimism with consumers
between the ears, buddy.
Exactly.
Absolutely.
We hear rates dropping, and yes, really no correlation between mortgage interest rates and the Fed's interest rates, but I think it builds confidence, or at least builds some optimism around that. And ultimately, I say this all the time, is that our biggest challenge is when the market was hot in 2021, we were all talking about the market. We were all talking about what people were winning, what they were losing, what they were having to give up. We were talking about this, and there was a lot of excitement around it. You haven't seen that. As many real estate agents have left the market, lenders left the market, people have changed industries. We don't really talk about it near as much as we should. And I think that's a big fail on the real estate industry. Lenders, title companies, agents, all of us combined. We're not talking about all the success that people are having, whether selling, whether, buying and, buying a house for $36 out of pocket, and all these things that are all these success stories or whatever. But even historic, houses are going, let's say, the majority of houses are selling for under asking price. They've still seen a tremendous amount of appreciation over the last 4 or 5 years.
Let me tell you a story, Billy. This is to your point, and you're hitting the nail right on the head. I just last week did 3. I'm going to take 3 refinances I did last week.
Sure, yeah.
And these were all clients of mine just over a year ago. And would you agree that the market today is probably better than it was a year ago?
From a buyer's perspective?
Yeah.
Yeah, for sure. Absolutely. 100%.
I think the market today is better than it was a year ago. Rates now are the lowest they've been in 3 years. I don't think a property is sitting on the market as long. I think it's overall a better, stronger market. So imagine a year ago, just over a year ago, last spring, these 3 different buyers, the conversations. Oh, this isn't the time to buy. Rates are 7%. This is the payment's going to be higher. Whatever. All 3 of those buyers, the average for last week's refinances saw appreciation, and we're talking homes that ranged in value from purchases of $400,000 to $550,000.
Sure.
That was
the
price
kind of the
point.
sweet spot.
These 3 buyers saw an average of about $80,000 appreciation in 1 year.
Sure.
$80,000 appreciation in 1 year, and we refinanced all of them from around 7 into the high 5s.
Yeah.
So think about that. If they stayed on the fence and they didn't make a move last year, they would have missed out on $80,000 in appreciation in 1 year.
Sure.
And none of them put down more than 10% on these purchases. So their rate of return in each case was through the roof because it's a leverage rate of return. They were complaining about rates being around 7%. Well, guess what? We got them into a rate in the 5s.
Sure, yeah.
So they are now at the rate that they wanted, but they have $80,000 more in paper gains.
Yeah.
But more importantly, all 3 of them were also complaining about the mortgage interest last year because they were putting less than 20% down. None of them are paying mortgage insurance anymore.
Right. Sure. Yeah.
They're all out of MI. They saw $80,000 average in appreciation on down payments of between $15,000 and maybe $40,000 at worst.
Yeah, for sure.
And they're in a fixed payment that's not going anywhere. Like their rental that they came from, I'm sure all of those buildings that they were in, I'm sure had contracts in the lease saying it's going to be 3% every year that we're going to have to jack your rent up
Sure.
to keep up with inflation.
And you can move, and then you can go and you can pay for a mover or go through the headache of moving or whatever to kind of try to keep that rental rate down or whatever. So, no, certainly lots of hidden cost, I think, associated with not being a homeowner. And that's something we talk about all the time too, is like, you can always refinance. And the beautiful thing about those 3 people you're talking about, Mike, is that the rates go back down again. Let's say they go to the high 4s. congratulations, refinance again. You know what I mean? Like, that's the beautiful thing about all this is that you continue to do that or whatever and see appreciation, and you're paying towards the equity or whatever. You're paying towards the principal every year too. So no, I mean, it's certainly something that I think if you don't own a home today, you really need to have a conversation about it, because maybe it's not for you. Maybe you don't want to take care of it. You don't want to maintain the house or whatever, and that's fine. But at the end of the day, I mean, it's like, what is the stat? Like 30% of all, everyone's wealth in the middle class or whatever is based on the equity in their home.
Sure. Like you said, Billy, like you marry the home, you date the rate. You can always refinance to a lower rate down the road. But you are purchasing an asset that is only going to appreciate in value while you pay down the liability associated with that asset. Think about where we are right now in terms of supply and demand for our area, in the DMV area.
Yeah.
Okay. Well, we have two things going on. You've got the majority of homeowners who refinanced or purchased their homes during COVID at like around 3% interest rates. They're not giving up those mortgages, right?
Sure.
So right off the bat, you have that lack of supply. Well, what's the other problem with lack of supply? It's the inflationary costs to builders to increase that supply. A plot of a half an acre in Vienna, Virginia right now is over $1 million.
Oh, sure.
Imagine what a builder would have to charge in order to buy that piece of land. And over the last 3 or 4 years, they've seen their cost of steel, lumber, all of those things have gone up significantly.
Sure.
So the cost of adding that new supply doesn't make sense for builders. So is that going to change anytime soon? Those mortgages were refinanced 3 years ago, and they're 30-year mortgages.
Yeah.
So supply is not going to improve anytime soon in this area. So you have the ability to go to sleep at night knowing that your biggest investment in your life, your home, is probably going to continue to appreciate steadily in value, or at the very least keep up with the rate of inflation.
Sure. And you have a fixed mortgage payment, or you have a fixed payment for the rest of your life.
Fixed payment.
You know what I mean? So that's the beautiful thing about that. So, well, Aaron, anything else to add?
No. Thank you for joining us today, Mike. We've had learned a lot from your talks. I did have one last question before we went. So you said, and I know the answer to this, but this is for everybody else. You said that DSCRs are slowly replacing hard money. That's only for rental properties, though, right? Not for like a flip or something like that.
Correct. For a timeline of, we're going to purchase this property that's undervalued, we're going to renovate it, and we're going to sell it. That's still absolutely what hard money is there for.
Sure.
DSCR is for rental property and portfolio building.
Gotcha. So I just wanted to clear that up in case anybody had any questions. So, but thank you everybody for joining us today. Southside Blueprint here with Billy Rabbitt and Mike Kosmides. Our information will be in the comment section below, and reach out if you need us.
Thank you.